Okay, let's dive into a massive financial mystery unfolding right before PagerDuty's Q2 earnings report. If you follow enterprise software, you know it's been a wildly volatile ride lately, but what is happening under the hood with PagerDuty? Well, it's uniquely puzzling. We're going to unpack the source material today and figure out exactly what the market is pricing in right now. I mean, check this out. Over the past 6 months, PagerDuty's stock has skyrocketed an incredible 82%. In the software world, a chart that looks like a rocket ship usually means one thing: an undeniable breakout. A viral product, massive new revenue streams, the whole shebang. With a trajectory like that, you'd honestly expect them to be the talk of Silicon Valley right now. So naturally, this massive rally leads us to ask, why? Why are investors suddenly throwing cash at this stock? What fundamental shift happened in the last 2 quarters to warrant almost doubling the company's valuation in just half a year? You would naturally assume the underlying business metrics are absolutely firing on all cylinders, right? Well, actually, here is the strange contradiction we need to investigate. Their latest quarterly revenue grew by just 1% year over year, and annual recurring revenue, the absolute lifeblood of any software as a service business, essentially flatlined. Think about that for a second. A stock is up 82% while the actual recurring revenue of the business has completely stalled out. And to make matters a little more concerning, dollar-based net retention dropped to 97%. Let's just pause on that, because it's highly critical. In SaaS, the golden rule is always to land a customer and then expand their usage over time. Anything below 100% means your existing customers are literally spending less today than they were a year ago. Maybe they're downgrading tiers or cutting seat counts. So before you even factor in the cost of acquiring new customers, their core economic engine actually shrank. Section 1. Following the cash. So to figure out what the market is actually seeing here, we have to look past the top-line growth. Think of it kind of like a restaurant where sales are totally flat, but they've somehow miraculously slashed their overhead costs. PagerDuty has become dramatically more efficient behind the scenes. Through strict operational streamlining and tight budget controls, look at this jump. They went from $29 million to over $41 million in quarterly free cash flow in just 1 year. That is a massive 42% increase in cash generation on basically zero revenue growth. That gives them a 34% free cash flow margin, which honestly is exceptionally strong for a company with stagnant revenue. They swung from a GAAP operating loss of over $10 million, meaning they were losing money just keeping the lights on, to a clear profit of $9 million. The company is playing an incredibly disciplined game now, prioritizing cash over growth at all costs. But wait, there's a catch. And this is why looking closer at the source data is so vital. PagerDuty also recorded $18 million in stock-based compensation for the quarter. Now, while that doesn't drain the actual cash balance in their bank account today, it absolutely dilutes the equity for existing investors. It means shareholders are bearing a real, tangible cost for this operational efficiency. We can't just look at that $41 million in free cash flow without acknowledging the equity they're actively handing out to achieve it. Chapter 2. The valuation. Let's look at the balance sheet to see how the market is valuing all this cash generation. It's a lot like valuing a house. You can't just look at the $444 million in cash sitting in the bank without factoring in the mortgage, right? PagerDuty carries about $396 million in convertible debt. When you adjust their $940 million market cap for both that cash pile and the debt obligation, it leaves us with a pretty modest enterprise value of $909 million. At under 2 times forward revenue, that looks incredibly cheap for a SaaS company, if they can get growth back on track. Chapter 3. The AI Bull Case. Let's interrogate the suspects driving this rally, starting with the bulls. Analysts like TD Cowen aren't looking in the rearview mirror here. They recently hiked their price target a massive 35%, moving it from $10 up to $13.50. And they aren't doing this because the past quarter's revenue was amazing. They are firmly betting on a turnaround narrative. The bulls argue that PagerDuty has fundamentally transformed its financial profile. They've hit GAAP profitability. They are flush with cash, which has allowed for a brand new $100 million share buyback program to help offset that stock-based compensation we talked about earlier. But the real game changer? Their new AI usage-based pricing model. The thesis is that as AI systems autonomously trigger way more complex digital operations and alerts, customers will just naturally consume more of PagerDuty's infrastructure. This ideally shifts their revenue growth away from simply trying to hustle for more user seats to actually monetizing the sheer volume of usage. And this brilliantly illustrates our central mystery today. What exactly are investors buying right now? Are they paying for a highly efficient but completely stagnant business today? Or are they betting the farm on a growth recovery that hasn't actually shown up in the financial statements yet? Chapter 4, the stagnation bear case. Because when we look at the bear case, the evidence paints a much more cautious picture. The bears point out that the core recurring business simply isn't growing. Existing customers are actively shrinking their spending, as proven by that 97% net retention rate. Plus, AI isn't just a growth opportunity, it's a massive competitive threat. Tech giants like Datadog and ServiceNow are rapidly bundling incident response capabilities directly into their broader software suites, challenging PagerDuty's standalone value. And finally, despite this explosive 82% six-month rally we started with, if you zoom out to the start of the year, the stock is actually still down 6%. The market might just be repricing the stock back to its baseline, hoping for a turnaround that simply isn't guaranteed. Chapter 5, the final verdict. So instead of getting distracted by headline earnings beats or volatile short-term stock moves, here are the precise steps our source material suggests you take when evaluating their upcoming reports. First, watch for actual ARR growth. It has to break above 0 to prove the core business isn't dying. Second, look for net retention to stabilize and push back above 100%, signaling that customers are expanding again. And third, demand absolute proof from management that their new usage-based AI pricing is actually scaling up to become a meaningful piece of the revenue pie. Therefore, our final verdict, based purely on synthesizing the source material, is to watch and wait for confirmation. The underlying fundamentals just don't yet support chasing this 82% rally blind. The enterprise valuation is undeniably attractive, and the massive free cash flow generation is very real. But the actual revenue growth narrative, right now, it's still just a theory waiting to be proven. Ultimately, this is the definitive question. Can PagerDuty turn its improving economics into actual ARR growth? Keep your eyes locked on that ARR number in the next report, because that single metric will hold the answer. Will this highly efficient software company prove to be an incredible turnaround story, or is it just a value trap masking a declining core business? We'll have to wait and see.